Excellent. All right. Let's do this, guys. Let's get started. I want to be respectful of everyone's time. This is slated for an hour. I don't think it'll take that long. I really just want to go through the information and make it as educational as possible. So again, we're Nimble Capital. Our company is been in business for quite a little bit of time. I'll give you guys a little background here on us, but this is the agenda, a little bit about us, our terminology. I like to focus on that. If you guys can type in the chat, if you're a first-time investor, if you're a seasoned investor, and if you've invested in multifamily before. So still participation from you guys would be great. Just type in the chat. Have you invested before? And are you seasoned, or you consider yourself a new investor? Why multifamily? Talk about the fundamentals there, the deal makers and breakers, why we're all here, and the outlook in our markets, at least the perspective of where we are and how we're taking a look at the market. So let's get started. A little bit about us. So Nimble Capital is myself, Mike Angelo, and my partner, Michael Wagman. We have about 663 units across 4 states, so 9 properties, all multifamily. We also own 2 sites that we are developing, one in multifamily, one in single family. And then we have a retail project that's a redevelopment. So predominantly value add multifamily with a little bit of development sprinkled in. We call ourselves Nimble Capital. So we give the opportunity to provide fantastic investment offerings, a mix of a variety of things where some investors like cash flow, some investors want to see a little bit of a bigger appreciation at the front end. And so it's a little bit of a mix. So we try to be flexible and nimble in that offering to the variety of investors, which is why we have a little bit of a variety in our product portfolio. So a little over 80 million in assets under management. And again, we're working on another 70 million or so in development. That'll put us right around $150 million. LP benefits. So I'm also an LP investor in about 1,000 units across 4 properties. And that really got us started in the business of, I wanted to experience what it was like to be a limited passive investor, earn that cash flow, and then built our model around what was really good, what I really enjoyed about being an LP. Now that we're on the active side, quick background is came from the construction supply space. So executive leadership, spent 10 years in that space. Between sales and leadership. My partner, Michael, who wouldn't be able to make the call today, but he came from the sales background as well, doing B2B sales. And, we have a little over 11 years of real estate investment experience, not just in this space, but prior to as well in the single family world. So let's get started. Again, this is a little bit of our portfolio, some of the existing apartments that we have in place. Again, predominantly multifamily. I would say we are blessed to understand multifamily. Class C is where we spend most of our time, B and C, and we have amazing partners in each one of these projects that has helped us operate these deals. So I'll talk a little bit about our structure and what's important when it goes into building a team, but the core team is Michael and myself. And again, we operate all of these. These aren't just funds that we manage. These are actual investments that we are actively involved in on a weekly basis with property management. So we roll up our sleeves. We visit several of these properties a couple times a year. And then, of course, on the development side, we're heavily involved with the contractor and the architect designs, all that kind of good stuff. So happy to answer any questions about us if you guys have any. All right, let's keep going. So here we go. Looks like nobody's working the chat. I want to make sure it's working, guys. Can you guys all hear me? Let's start with that. So I'm going to pause here for a second. We lost a couple people. Oh, here we go. All right, I got a couple people back. I just want to make sure you guys can all hear me. I'll keep an eye on this in the corner. All right. So a couple terms. Just again, for those of you that are unfamiliar with multifamily, there's a variety of commercial, residential terminology. So when you talk about residential, it's single family typically. Small multifamily is up to 4 units. So a duplex, triplex, fourplex, that's still considered residential. And then you move into commercial multifamily, which is really 5 units and above. Our target is predominantly 100 units plus. We own from 20 to 200. So a couple different ranges there, but that's typically considered a commercial loan. And really the reason it's commercial is it's the way the loans are structured. And I'll talk a little bit about that in a little bit. Another segment of the rental space is built to rent communities. This is called BTR from time to time. And what you'll see with these is these are large, they look like single family developments in a community, but they're all individual units, but they're actually all rentals. So they're not for sale. They rent, sometimes they're 1, 2, and 3 bedroom units. Again, looks like small, tiny homes, in the communities all around us, really all around here. I'm based here in Phoenix, Arizona, and it's a very popular business model that you're starting to see. So you're starting to see your traditional garden style apartments, your high-rise apartments, and now you're starting to see these built to rent communities. So they have a lower density, meaning they're spread out, a little bit more space. Most of the communities have yards and pools, just like an apartment complex, but it's an individual. Here's some of the terms. I'm not going to go through each one of them, but as they come up, it's an important piece to talk about. If any of you have questions around what these terms are, net operating income, that's basically the bottom line profit, expense ratio, those are things that talk about in the operating side of the things. So everything on the left is really operating terminology. Everything on the right is more around the loan, debt structures, kind of how markets are looked at. And so just some other terms that you may see. And if you see something you don't understand, please raise your hand, and happy to answer questions for you. All right, so multifamily during a recession. Why do I bring this up? So if you are feeling it, if you're looking at the data, we are in a recession, if not working through the recession. Why is multifamily a great investment? So why do we believe in it? At the end of the day, large apartment complexes are typically very stable during tougher economic times. Sometimes households consolidate, they move down. Some people sell their homes and move into an apartment. You usually typically see residential real estate do okay. Sometimes it does not so well, but multifamily does pretty well. And again, we have data showing all of the occupancy levels being relatively stable and doing pretty well. People do tend to prioritize their living space. So where they live, if they are a renter, they're going to prioritize paying rent to make sure they have shelter. So food, clothing, shelter does take priority. And so those things get prioritized over, say, credit cards or other bills. Increased rents. So ironically, even though times might be economically tough, because there's increased demand, there typically is a higher rate of rent increases across the marketplace. We haven't seen this yet. In some of our markets, the rents are still going pretty well. But even though there are overall economic headwinds from a national perspective, you'll see in certain markets where there's a lot of demand, that rents can continue to get pushed. So what does that mean as an investor? We'll typically be able to achieve reasonable rent increases throughout a rougher time. And again, we're not in the business of just raising rents just to raise rents. If we make an improvement on a property, we invest in the property, we do look to get some of that back, and we do that through rent increases. So the big piece of that is, low cost fixed rate debt is kind of the best way to guarantee yourself good sustainability through rougher times. And we'll dig into a little bit of the deal breakers that are part of this piece that can be challenging in a time that we're going into right now. So let's talk about one couple more things. Is less turnover. During tougher times, people tend to not want to move. Moving is expensive. There's a cost. And so if the rent is cheaper, maybe down the street at $100 less per month, well, it might cost me $500, $600, $700 to rent a truck, rent movers, or bring people in to help me. That cost might just be better to be absorbed, let alone the time and trouble to move it. So people just might accept the rent increase. And again, when we look at rent analysis, we might be looking at 1 or 2% rent increase, sometimes 3%. It really depends. We are in the class B and C space. So our average rents across our 663 doors is right around $800, $850 actually. So a 1% increase is not that much, right? 10% increase is $80, right? We're not doing even an $80 increase. We might do 3, 4, 5%. So you might see $20, $25, $30 increase per month annualized on a new lease, right? So we want those people to stay. And we really try to explain that, utilities cost more. There's actually higher costs of maintenance, so those costs get absorbed and passed on to the tenant. The one area that might get more impacted in the multifamily space is Class A. So Class A is, it can be two ways. One, it's untouched because that demographic doesn't necessarily get impacted by the recession. They just might be more, more resilient to those types of downturns. However, if there is, sometimes those folks go from Class A to Class B. And so you might see a downturn where there might be slightly higher vacancy in those Class A assets. B and C, typically you're going to be in the 90+% range, depending on the marketplace. And this is why we do a lot of research around finding out where the market is, what the trends were back 10 years ago, 15 years ago. The Great Recession now was 15 years ago now, right? Coming up on that. So we want to be able to look back and see what those trends were and how that marketplace is different today. There's more jobs, ideally, there's more higher median income. Those all factor in. This is the other piece, is supply. So existing housing supply. This is specifically around single family homes. So today we have a $3+ million shortfall in single family homes. Having low inventory like that is going to do a few things. Well, first we have higher interest rates, but you also have low inventory. What that does is it provides a lot of pressure, creates a lot of pressure on housing units. That's why you're still starting to see that home prices haven't really dropped that much. I think we're going to see more of that come down. However, the demand for rentals is still going to stay high because there's people that just can't afford necessarily, one, afford the home, two, availability of home because there's so much demand. You could see here, typical monthly mortgage payment, median priced home now is $400,000 across the US. That mortgage, is $2,700. The average rent across the country is $1,900. So that difference is 36%. And so it's a pretty substantial difference from just a home affordability perspective, not just supply. The other piece of it is, this is the housing gap, the income housing gap. So this chart here on the left, I really like it. I used it on our last webinar, is, you really had about a 2 to 2.5x income to house cost back in the 1980s, right? And as time went on, that gap has significantly increased. So the cost of a median home has gone up almost 6x versus the median income. So median income has increased, but you will go from a 2.5x to a 6x, nearly 5.8, 6x difference. So the average median income gone up to about 70K. The average home price is 433. So that is such a substantial growth. The affordability is just becoming really challenging. And this is the same chart, just in a visual, more of a graph standpoint. You can kind of see price to income and how much it's gone up over the course of time. And that's just a challenging piece. What does that mean for us as investors? Is that there will be more opportunities in the rental world than there will be in single family potentially. So we really believe in providing great homes, great single family homes. It's not what we do. We provide apartments. So our goal is provide great apartment buildings, clean those up, renovate them, and make them safe, affordable homes for our residents, right? All right, so now let's look at deal breakers, deal makers. This is really the core of the webinar today. And I'm going to dive in a little bit deeper into some of these areas. And again, if you guys have questions, feel free to chime into the chat. I want to make sure it's working here. Okay, yeah, no questions at this time. So here's what you see. Typically, debt is the last thing you look at. So when we underwrite properties, in the last 5 years, we've underwritten 2,000, 2,500 properties, at least a few $1 billion worth of assets. And many times you look at debt as the last thing. So meaning, I'm going to plug it in, I'm going to see what the numbers look like, and then I'm just going to plug in a generic piece for debt. Well, the market has changed significantly where you need to look at debt today. You need to see how that debt impacts the market and impacts the specific property, So debt structure at the very top there, can I assume a loan? Loan assumptions are very popular at the moment. It's a great way to buy an asset, which might have low fixed debt. So we actually own an asset right now. It's an open investment today where our fixed rate debt is 3.85. How is it 3.85? If you look at the market here and all these rates today, if you're trying to buy a new complex today, depending on the size of the market and where you are, you're going to be around the 6% range. Some of these start with a 5. This is all as of today, August 6th, actually as of yesterday. So 6%, 6.5 is what you're going to typically see. So if you're in a medium-sized market or top market, you're going to be a little bit better. We're typically in, San Antonio, Dallas, Tulsa, Oklahoma. Those are between standard and small. And so that's 6%, 6.5%. How did you get 3.85, Mike? Well, we got 3.85 because we assumed a loan. So we went to the seller. We looked at their loan structure. They had fixed debt, 7 more years. We were able to assume that loan because there's still time left, and 3.85%. Well, that makes it immediately attractive. Now, the other factors have to come into play. We still need to see if there's good upside. Is it a good value to pay the certain price that he wanted, right? So we were able to do all the underwriting, but the debt became a really important piece because that extra 3%, give or take, we're assuming a 3% difference between today's market and what our interest rate is. That gives us immediate cash flow. And that's something that we really look at. Cash flow on day one, right? With an assumable loan, you'll typically get there. But even with new debt, can we drive towards cash flow on day one? Not every operator is like that. We are different. We really want to see cash flow at least a few percentage points on day one. IO period, interest only. That's what IO means. What's the interest only period? I can negotiate 1 year, 2 years, 3 years. It really depends. The longer IO period I have, the more cash flow is available. This is not about paying the loan down. This is unlike your single family home or your private personal residence. You really are here to maximize cash flow. And so, you start amortizing your loan, which means you're starting to pay down the principal. That's fine. Eventually, you'll do that. But at the first onset, you really need as much cash flow as possible. So you want to minimize your payment. Fixed or bridge. We at fixed. All of our deals are now fixed. Bridge debt. When would you use bridge debt? Well, just like the name, the metaphor is, I need to go from an unstable asset to a stable asset, and I need a bridge process or a bridge loan to get me there. And so bridge loans were never designed to be 5-year deals. They were supposed to be 1, 2, 2.5 years, sometimes 3 years. They come with a lot of volatility because the rates vary. They go up and down, and you've seen them go very much up in the last year and a half. They're just now starting to trickle down a little bit. Other things we look at is prepayment and loan terms. Unlike single family, most commercial loans have a maximum maturity date of 10 years. So you can get 5 years, 7 year, 10 years, sometimes 12 year. That means it's a balloon payment due at that time. We typically don't hold assets for more than 5 years. So it's well within that window. If it goes to 7 years, it's fine because that's the kinds of loans we typically get. But 5, 7, and 10 years is typically what you see. So that's the big piece is debt. The next big piece, this is kudos to Neil Bawa, Real Focus. So if you have never heard of Neil Bawa, he's an amazing operator, apartment owner, investor, and a bit of an economist. I don't think he definitely claims to be an economist, but he has great data-driven information. And so when we look at the market, what are the things that you should look at? And this will really determine, at a high level, 30,000 foot level, what markets meet the criteria. You'll need to dig in a little further, but you can pick any market in the US. There's some resources available to you guys for its free information. Believe it or not, Google has this data, city-data.com. It used to be the source. It's still pretty good. It's a little bit dated, but it is out there. So one thing to look for is population growth. You want to see positive population growth, 20% plus over the last 20 years. So this says 2017. Today is 2024. So you're really looking back about 20 years, 17 years in this case, and you're looking for at least 20% growth. For cities over 1 million, you're looking for 15. Over 2 million, you're looking for 10. Anything under 250,000, you're really looking for 30% growth. And those really make a difference because if you compare a Dallas, which I think has 10 million plus people in it, to a Albuquerque, New Mexico, which has a little over 2 million, big difference. Well, you can see the percentages of growth that will vary, significantly. And so those are just really important things to look for. You don't want negative population growth. I think Chicago, Illinois today has negative population growth. Median household income. You want to see an increase in median income over the last 20 years. And really what's happening in the last few years to see if that trend is continuing. Did an industry move out? In the Midwest, you saw a lot of coal and oil and gas markets. Those plants shut down. Those markets really died. All right. So you're really trying to track where is the trend today and where's it going. So if you can get a projection, those are always good. But those are the metrics that we look for. Median household or condo values, right? Is there an increase in home values? That correlates typically with income and population. Crime. Crime index is really critical. You will see crime, there's really a number below 500 that's good. And so you want to see a trend of crime going down. And those are submarket specific. But if you type in Los Angeles, California, the crime rate could be substantial. But if you look at a specific suburb or a neighborhood, then you'll be able to drill down a little bit more and see what the crime is. The other piece is job growth. This is probably the most important out of all of these is what is happening in the economy? Can the economy sustain itself? And what happens if, right? Especially if you start looking at medium-sized markets, smaller markets. We're looking at a market called Tulsa, Oklahoma. It's not a main market. It's a smaller market. Plenty of people there. But what's the job growth look like? And if you start looking at the amount of occupation that's coming into the market, it's phenomenal. And it's rivaling Phoenix, Tulsa, Tampa, Dallas, Texas. Big markets, just as good, but not on everyone's radar. And so as kind of specific operators, we don't want to be where everyone else is. We love Dallas. It's a heavily saturated market. It's not a market we're going to play in because we think there's other markets where you can make just as much return without the competition. So I'll show you that here in a second. So here's some data to compare. So this is from Freddie Mac, Fannie Mae. So this isn't Mike's data. You can look this up from Q1. Here's some of the cities, right? They're just comparing. You see some big cities and small cities. So even just San Francisco, California, 3% income growth, 4% vacancy rate, right? So that means they're 94%, 96% occupied. Tulsa, Oklahoma, 4.7, 3.5. Albuquerque, New Mexico, we own assets in Albuquerque and Tulsa. These markets have seen actually much higher than this, almost 5% rent growth in the last couple of years, even through this last year where there's been more pressure. So you can see Albuquerque's vacancy is basically 97.2%, right? It is phenomenal. It's almost 100% occupied. So, and we see that in our property. We're in a great part of town, lots of demand, never have an issue with vacancy. Somebody leaves or gives notice, we can fill that door immediately. And so these are things that we look at, but across the nation, you're seeing 2% rent growth. There's definitely markets like Dallas, Phoenix. I live here in Phoenix. We saw a little bit of a rent decline temporarily. San Antonio seeing a little bit of a rent decline, but we're going to work its way through that because there's another side of things called supply. A lot of new product comes out that drives up vacancy in the marketplace. But here's those three metrics that you saw on the last slide: population growth, personal income, and job growth. So you can kind of see just across the market, these are some phenomenal numbers. For population growth, you want to see 20% or better, right? Look at these numbers, 20%, right? Even Tulsa hits it. Personal income, Dallas, 84% increase. Atlanta, Georgia, Tulsa, Oklahoma, not bad. You're looking for 10, 15% increase. Job growth, you're looking for 2% job growth. These markets blow it away, right? Of course, Dallas has a huge amount of growth. Atlanta has seen a lot, and so has Tampa. That's because a lot of companies have moved into those markets. Well, that's great. That also means everyone else is looking at it too. So it's really important to kind of just figure that out, right? And see what works for you. Not everyone needs to be in Dallas. We like Dallas. We own a property there, but we like other markets better. They've done better for us. All right. So then this is kind of the other piece of it is, in the submarket, you need to look at, let's pick a market. We've picked Albuquerque, New Mexico, Dallas, Texas. Hone in on the demographic and then the asset class. So we talk about the properties vintage is one piece, but within the demographics, within Dallas, for example, Dallas is a huge, huge city, huge metro. There's very neighborhoods that you don't want to be by. And there's neighborhoods that you do want to be in. And so, we kind of classify those A, B, C, and D. You're highly affluent, middle class, blue collar, high crime. We really play in this space. We don't play in the class D. Blue collar is where we are. That's the tenants we serve. We believe we can maximize their benefit by improving the assets because they usually don't get as much of a lift in renovating their units. But when we do that, we also improve our bottom line, which then improves our investment returns. So it's a win-win from our perspective. Absorption. So if you're playing in this, A and B space, new supply will impact you. If you're really in the C space, doesn't necessarily, because the folks that live in this space are not typically living in this type of property, right? The brand new property is typically going to have a much higher rent than your blue collar. Example, San Antonio, Texas, we own a C-class asset. Our average rent is $950. A little bit down the way there, a few miles, high-rise complex, one-bedroom apartments are going for $1,600, so nearly double. And so that tenant demographic isn't going to move when that new place opens up, right? There's a lot of stuff in between they could, right? But looking at that, that's just something to consider. Competition. You got to be able to use your property management companies to do a competitive analysis of what's out there. Because the one thing, and I love brokers because they bring us deals, but your broker package will send you an OM, an offering memorandum that will show you have all this rent upside, $200 per unit rent. Is that really true? What has been happening in the marketplace? What's the market occupancy? What are the specials that are being run? Because something that's not considered here is concessions. So concession, if you've never heard that term, is really a rent discount. So $99 move-in special. $500 off your first month, whatever. Those are all different discounts that impact your revenue. And so when you're trying to recruit people, right, attract people into your apartment complex with the big flags and all that kind of good stuff, you're going to have a lot of competition. So if you have a lot of new product out there, there's going to be a lot of people asking for their attention. When you have an existing older asset, still the same thing, right? You're going to have other 1960s, 1970s, 1980s products. And so what can you do to be able to garner their attention? But it will affect your income. And so when you underwrite, when we dive into those deals, we typically put in a 3-4% concession piece, a bad debt piece, and then vacancy. Typically, we take the market vacancy, which again, right now, let's use San Antonio, Texas. The market occupancy, I should say vacancy. The market occupancy is 93%. It's not 100%. It's 93%. So that means the most I can get to is 93%. So if I'm underwriting, I want to make sure I'm at least a few basis points below that. 90, 89, 90% is where I kind of want to find the sweet spot. If I overperform, that's great. But if I go to 95, 96, which we have seen in a lot of deals that come across our desk, that's being a little too bullish. And honestly, that's going to create disappointment because you're going to underperform. And I just talked about submarket vacancy. So those are really the pieces. And you can see this is Phoenix here. I just pulled this morning. But you can see across the board here, the average annual absorption. I don't know if I talked about absorption a little bit, but there's a lot of opportunity here. You can see we created a lot of new units, a little less delivery. So it's going to take a minute for that to come down. And what you'll see here is the vacancy rate went up as new product came online. So that kind of ties into what I was talking about here. Vacancy rate, relatively average vacancy is pretty much stayed stable, but again, peaks and troughs that come into play. All right, another big piece. Let's talk about the property now. So we talked about debt, talked about the market, talked about the submarket. Now let's talk about the property itself. So vintage, Class A, B, and C. Really, the newest stuff is Class A. Last 5 years. Class B is 20 years and below, and then C is a little bit older than that. When we play in the Class C space, there's really a lot of things to factor in. One of the biggest things to look at is one visual appeal, right? Is it kind of roof systems you have? You have something called mansard roofs. It's a really funky looking kind of it's got a roof here and a roof here and then another roof here. Those roofs tend to leak. They cause challenges. We like shingle roofs. Flat roofs can tend to leak. HVAC systems, mechanical electrical systems. You got a picture here of a chiller. This is an industrial chiller, but a lot of older apartment complexes have chiller systems rather than large AC units that supply AC or air conditioning to each one of the apartment units. So this is a master system. Typically, it's water cooled, so it doesn't necessarily run on Freon. You got water that gets cooled by the chiller, runs into each one of these units, and inside the unit, they have something called a fur down. That cold water gets blown with a fan, and that creates the cold water. So you want to get 50-degree water in there. So when the fan blows over it, it's blowing cold air. You typically get your unit down to 70, 72 degrees. So Texas, you see that a lot. New Mexico, you see a lot of swamp coolers, very popular. A lot of our properties have swamp coolers. But those are things to consider when you're buying a deal or looking to buy a deal. How much money do I have allocated to these big infrastructure systems? This can make or break your property. If you have a chiller go down, a third of your building could have no heat or no cool, right? There's a heating system and a cooling system with these. When's the last time they were repaired? Things we look at is we ask for a schedule of CapEx. We want to know when the last time those repairs were done, what else has been going on at the property. Electrical systems, Zinsco, Stablock, those are kind of the two brands that are now banned essentially. So as you're buying a deal with fixed rate debt, agency debt, Fannie Mae, Freddie Mac, those are the two big agency companies, organizations, I should say. They will require an inspection, and they want to know if those breakers are existing, that those get taken out. The reason those two are the most common that come up as an issue is those were basically built in the 60s and 70s. They were used a lot, and they tend to catch on fire. So they're not to code anymore. They have to get changed out. So that's something we look at. We actually had a deal in Albuquerque, actually. We had Zinsco breakers. We knew up front when we did our due diligence, we walked the property and we worked in $25,000 to go in and upgrade all those panels. So it was part of our business plan. It's not a break and make or break, but it does affect the offer, right? Now, $25K on a $5 million deal isn't that much. However, it could be. That could be substantial. Maybe it's $50,000 or $100,000. Well, where's that money going to come from? That's typically either equity or we bring it in. That money could be allocated to something else that would rather improve the property. These replacements don't improve the property. They just bring it to code. They don't create revenue. And so these are things you have to do. They don't necessarily bring value. Water conditioning is another huge piece, especially in states or cities that have hard water. San Antonio, Texas, Dallas, Texas, super hard water, very, very hard on your equipment. So not only your chillers, but your faucets, your shower stems. If you want to lower your maintenance costs, get a good water conditioning system. They're expensive. I think we spent somewhere around $10,000 to be able to install water conditioning units where they put a softener in and then they put chemical treatment. That keeps the pipes clean, prevents leaks though. So it's well worth the investment because you figure one bad leak could be $5,000, $10,000 pays for the unit, right? So we've learned some of this through the last 5 years of working through challenges, right? Sewer systems. So antiquated and old properties have typically clay, cast iron, sometimes a combination of those two. Galvanized pipe, those get corroded, they wear out. And so you can get a sewer leak somewhere, sometimes underground, sometimes it's a backup. We've already done in one of our properties quite a bit of extensive sewer repair. Part of the process, some of it is unexpected. And so one of the things that we try to do is have an additional contingency in all of our property purchases. So if you're allocating $500,000 to sewer, for example, or piping or plumbing, you may need an extra 10% because other things will come up, right? It's just the reality of it. And you don't want to get caught off guard and not be able to do those repairs. So it's really important to be able to do those pieces. Some of the other areas, foundations, roof, I talked about a little bit, but the last one is a little bit not talked about as much, the tenant quality. If you're buying a property specifically in Class C in a blue collar neighborhood, you might have a certain reputation to look at that you need to repair or at least elevate. And so the first thing we typically do is we go on Google, we look at what are tenants saying, what are people saying about that property? What's the review? Now, if it's a 2.0 or 1.8, we look at why and are those items fixable? You'll see it. Sometimes it's just bad management, pest control issues, air conditioning issues. You might have a series of issues. Some of those can be fixed, and some of them may not be fixed, or it'll take a long time to do that. So, we have several properties where we've turned over nearly the entire tenant base, and other ones where they just trickle out over time. So you got to figure if you have a 100-unit property every month, right? Take 100 divided by 12, right? You're going to have 8, 9 people per month that their leases will expire. And out of 8 or 9 people, you hope most of them will stay, right? You want to make sure you do a good job, but they could be moving, they could get a new job, they could just want to buy a house, right? So you might lose half of them just to natural attrition. The other 4 or 5, you may just be able to, they may just not be happy. And so keeping up customer service and making sure you meet the work orders is important. But sometimes those are non-paying tenants or not the best paying tenants. And so you might want to elevate your tenant quality by looking at opportunities so where, hey, this is not the best tenant. They haven't paid. We've had to file for eviction multiple times. They've been able to get out of it. Those are tenants we don't have to renew, right? And there's a lot of debate depending on which side of the fence you're on around, paying rent. At the end of the day, I have to pay a mortgage, right? I live in my house. If I don't pay a mortgage, the bank comes and takes my house, right? Just like rent. They don't get to stay for free. I know last couple of years, a lot of that happened out there. And unfortunately, we were victims to some of that where we still had to make a bank payment, right, for the property itself. But a lot of our tenants chose not to pay rent. As soon as we could, we evicted them because that's just the way it works. And so that's depending on the state you invest in. Some states are more friendly than others. So I'll pick on California, not a state we will invest in. Just unfortunately, some of you might be from California. Buying apartments there and owning apartments and having tenants pay, you could run into a challenge where they have a lot more rights. Where in Texas, Arizona, New Mexico, it's landlord friendly, and they understand that it's a business, and that exactly what it is we're providing housing. They need to provide some kind of rent income in order to stay in that house. So an important piece there. And really, let's talk now about outlook. So if you guys have any questions, again, just type it in the chat. Our outlook specifically, we believe, the rest of 2024, we're essentially already in Q3, headed to Q4. Commercial rates are going to stay probably about 5%. This actually said 6%. But you can see the last couple of days, the Fed has dropped the rates a little bit. And I think it's going to stay around 5. And that still sounds like a lot relative to 2 years ago where money was, sub 3%. 5% is a great place to be, guys. It's going to keep certain competition out. It's going to allow prices to stay relatively stable. When interest rates drop, the problem is everybody jumps in, and operators like us or anybody, we stop buying because there's too much of a frenzy, and people buy because they think the debt is free, it's cheap. And while that's true, you overlook fundamentals. All the things I just talked about, all those deal breakers, deal makers. If you forget debt for a second, but you look at all those other pieces, those are just as important as the debt. And so you got to be able to not overlook, hey, we can afford to buy this property or pay a little more because our debt is cheap. It's not a good answer. Your debt is your cost of debt should be a bonus, and it should be a factor, but all the other things come into play. It's really important. So we're going to keep our transactions probably relatively low. We're looking at a few deals now. I think there's going to be more distressed assets as the floating rate debt loans mature. So you're going to see a lot of those maturities. We talked about bridge debt, the 1, 2, 3 year debts. A lot of those are coming to fruition or maturity, which means if they can refinance, they will. But a lot of times that refinance was based on two things. One, the cap rate and the income. So the income being the bigger factor. If they were able to increase their income, but they have to divide it by a higher cap rate, they may not get the loan proceeds that they want. That's something that we actually experienced. We just closed on our Freddie Mac loan. We went from bridge to perm debt. And because we outperformed that property, even though the cap rate went from a 4.5 to a 6, which is 1.5% up, it increased that much. We were still able to achieve the loan proceeds that we need in order to, and it was more than what we paid for the property in order to get the refinance done. But that's because we drove the hell out of the NOI, right? We were able to lower expenses, increase our rent. If you're not able to perform that way, it's going to be really hard to refinance, which means some of these folks are going to be in trouble. There's going to be some distressed sales out there. Equity, I think, will continue to tighten probably through the elections. And I think, whichever way it goes, there's going to be a change in sentiment. Could be good or bad, but a lot of folks just kind of pause during the next couple of months. So I think it'll be a challenging time for 2024. 2025, I think there's going to be a lot of absorption happening because I talked about all those units being delivered in markets like Phoenix and San Antonio. Again, I'm based in Phoenix. We own in San Antonio. We're building here in Phoenix. We're going to see some absorption, and that's going to create a little bit of challenge for the next, again, year or so, and then it'll be right back to heavy supply pressures because of all those low deliveries, right? A lot of folks stopped building this last year because of where interest rates went, because of where values went. We still have a need for units, folks. So getting those folks to come up and start building those again is what we're going to do. We're going to be a little bit delayed on our project because of that, but we hope to move very quickly and get that thing out of the ground. And so that we'll be early on the first batch of deliveries. We talked about Feds easing the rates. I think they might ease it a little bit more. I think we're down 50 basis points today. All of that could compress cap rates back. So there's cap rate, which is, again, capitalization rate. So as cap rates go up, that affects the values of the properties and lowers them. As cap rates compress, that's going to increase the value. So we see some combination thereof. Again, the more transactions you're out there, the rate, if the interest rate drops a little bit, a lot of people jump back into deals. I think it's going to be interesting for the retail kind of investor. For deals that we're looking at, we really want to stay and focus on potentially distressed assets or deals where we can assume the loan. We can assume a loan from a tired buyer, tired operator. That's a great place for us to be. And I'll tell we have a deal right now, actually, that's exactly what's going on. So going into what we're doing specifically, right? Operational inefficiencies. That's really where internally the properties we own already, we're looking into do everything we can. AI for property leasing, driving traffic, just doing good analysis on operations, automation and tech. So we have, wireless door locks. We're doing wireless thermostats, improve our cash position. Having as much cash in the properties is really important. And we've always kept at least 3 months of operating reserves. We bumped that to 4 or 5. That means if we collect zero rent for 4 months, which is pretty tough place to be, we'd have enough cash to not run out. So we're just improving those, building those back up as we, continue to pay distributions. We want to go vertical on our development projects. We'll talk about that. And then continue to invest in the markets we're already in. So, we're planning for zero rent growth, really kind of buying for 5+% cash on cash. This is key because if I can, again, if you guys are investors or looking at deals, and I can bring you an opportunity where I can tell you on day one, if we do nothing at all, that we can earn 5%. That's a great place to be. That's like a high yield savings account. Obviously, operational efficiencies come into play, and this gets increased significantly. So this is a needle in a haystack, but we know they're out there and we're looking for it. So I talked about loan assumptions versus new debt. These are the markets we're in. These are likely the markets we're going to stay in. I could tell you about almost every other block in the markets that we own in the neighborhoods that we're near, and if it's good or bad. And I can't do that for every market. So these are the ones we choose to be in, and we'll likely stay there. So if you're interested in any of these markets, you want to learn more about what we do, please reach out to us. That essentially concludes this webinar, guys. If you guys have questions, feel free to reach out. We do have a great investment offering in Oklahoma right now. It's that fixed rate deal that I talked about, 185 units. You can see and email us here at info@Nimble Capital. Cell phone numbers down below. Happy to reach out. I'll give it a minute if you guys have questions. Edwin, hey, thanks for joining, man. Gary, Robert, anyone else have questions? Feel free to chime in. If not, I want to thank everybody for your time. We will be sending this recording out here in the next day or two. And please reach out with questions. Thanks again.